Have you ever wondered what truly goes on inside, one of the world's biggest banks? Beyond the headlines, what does it actually take to manage trillions in assets, navigate all these global risks, and just, well, keep the lights on for hundreds of thousands of employees and millions of customers every day?
Yeah, it's fascinating. And today we're taking a deep dive into Bank of America. We're going to be pulling back the curtain using their own words specifically, their recent SEC filing. And this isn't just about parsing numbers. It's really about understanding that intricate dance of human capital, market forces, regulatory tightropes, and the technological frontiers that shape a real financial powerhouse.
Right. And our mission here is to quickly but thoroughly equip you with the essential insights. And maybe some surprising facts from this, let's be honest, pretty dense corporate document. We want to give you a shortcut to being well-informed about a major player in the global economy, all without getting, bogged down in the jargon.
Exactly. Our primary source for this deep dive is a comprehensive SEC filing from Bank of America. It covers their operations, financial performance, and outlook as of December 31st, 2024, and into early 2025. Think of it like getting a direct briefing from the bank itself, laying out its inner workings.
Okay, let's unpack this then. So let's start with a glimpse inside Bank of America's actual structure. Because it's far from being just one, monolithic thing, right?
Not at all.
They operate through four main business segments. There's consumer banking, global wealth and investment management, GWIM, they call it global banking, and global markets, plus that kind of catch-all, all-other category. What does this diversification tell us about their strategy?
That's a great place to start. Each of these segments provides a really diverse range of banking and non-bank financial services. Take consumer banking, for example. It goes way beyond just your checking account, right? It includes consumer and small business lending, so credit cards, mortgages, vehicle loans, plus managing relationships with small business clients.
Yeah.
This breadth means Bank of America isn't just a consumer bank. It's really a critical engine for the broader economy. It touches everything from, your mortgage to your local small business loan. And this diversification, it isn't just about grabbing market share. It's a strategic hedge.
Sure.
It makes them surprisingly resilient to shocks in any one specific lending area.
Right. That makes sense. And then there's JWIM, Global Wealth and Investment Management. Is this segment purely asset management, or does it involve a different sort of client relationship, maybe a different risk profile compared to, say, their consumer banking side?
That's a great distinction. GWIM, which covers Merrill Wealth Management and Bank of America Private Bank, it focuses heavily on more bespoke financial planning, sophisticated investment strategies for their, affluent clients. It's a very personalized, relationship-driven business, which means their client retention strategies, even their regulatory obligations, can be quite unique. Then you have global banking, serving the larger corporations advising on M&A, managing their day-to-day corporate finances. And meanwhile, global markets is handling sales and trading across a huge range of assets, bonds, currencies, equities, plus those critical market-making and clearing services that essentially keep financial markets, liquid.
The sheer scale of this whole operation is just immense. I mean, to put it in perspective, their consumer banking network alone includes something like 3,700 financial centers, 15,000 ATMs across the country. And in the digital space, they serve, around 48 million active digital users, with 40 million active on mobile. That's a staggering physical and digital footprint.
There absolutely is. It highlights their reach. And speaking of reach, the competitive landscape they operate in is incredibly diverse now. They're up against traditional banks, sure, but increasingly they're also battling firms that operate, solely online.
We're the fintechs.
Exactly. And even non-financial companies leveraging emerging tech like digital assets. It really raises that important question. How do traditional banks adapt? Especially in such a rapidly evolving landscape when new players can just pop up overnight with fundamentally different models.
That's a huge challenge for any large established institution, which kind of brings us nicely to the human element. Bank of America often talks about being a bank of opportunity for its employees, or teammates, as they say. The filing gives some interesting details on how they invest in their people. They have a massive workforce, around 213,000 employees.
That's practically a city.
Yeah.
And they focus on providing clear paths for professional growth and maintaining what they call a culture of caring. The numbers seem to back that up, too.
Yeah.
In 2024, over 12,000 employees moved into new internal roles within the company. That shows real internal mobility.
Wow, 12,000.
Yeah. And they invest enormously in their people, delivered about 7.6 million hours of training and development just last year through their Bank of America Academy.
That's a lot of training. And beyond the formal stuff, they have these 11 employee networks with over 320,000 voluntary memberships, fostering personal and professional growth across different business lines. It really seems like they're trying hard to keep their employees happy and engaged. Their annual employee engagement survey in 2024 had like 87% participation and an 84% employee engagement index, which sounds pretty high.
It is, especially for a company that size.
And what's more, their turnover stayed stable at 8% in both 2023 and 2024. That stability really does suggest strong employee satisfaction, I think.
I'd agree. And their compensation philosophy, they state, is pay for performance. They benchmark against other companies to ensure they're competitive. They've also been steadily increasing their minimum hourly wage for U.S. employees hit $24 an hour in late 2024, with a target of $25 an hour by 2025.
That's significant.
It is. And what's fascinating here is just the sheer scale of investment in their workforce. You see it reflected in things like in January 2025, for the 8th year running, about 97% of their global employees got these Sharing Success Compensation Awards for their 2024 work.
Wow, nearly everyone.
Yeah. They also state they're committed to equal pay for equal work and offer pretty extensive wellness programs, physical, emotional, financial health. It seems clear they view their human capital as a core asset.
Okay, so moving from people to potential pitfalls, let's talk risk. How does a giant like Bank of America navigate the, well, often turbulent waters of risk? What's their core approach?
Well, they use a pretty comprehensive framework. They identify 7 key types of risk: strategic, credit, market, liquidity, compliance, operational, and reputational risk. This kind of detailed classification is really essential for an institution of their complexity.
Okay, 7 key types. Let's maybe dive into market risk a bit more. That's primarily in their global market segment, you said.
Right.
They lean heavily on VAR models, value at risk. That's basically their estimated worst-case loss on a normal day, right?
Exactly. Think of it as their daily worst-case scenario gauge. When they say 99% confidence over one day, it means they expect that 99 out of 100 trading days, their losses won't exceed that calculated VAR figure. It's like a financial airbag for immediate market shocks.
But they don't just rely on that, do they? Because VAR has limitations.
Precisely. They also conduct stress testing. They use both historical scenarios, like simulating a severe past crisis, and also hypothetical ones, trying to go beyond what VAR might capture.
Okay.
This is important because, historical data can't always predict those black swan events. And the filing notes that in 2024, they actually recorded positive trading-related revenue for over 99% of trading days.
That sounds pretty good.
Yeah, and the largest single-day loss was $12 million, which, in the grand scheme of their trading operations, is relatively contained. It suggests a decent handle on daily market moves.
But of course, the bank faces a whole spectrum of risks, and some are evolving incredibly fast.
Definitely. Protecting against disruption isn't just about financial models anymore.
Right, like cybersecurity. The filing makes it clear that cybersecurity and broader operational risks are escalating concerns. I mean, with their increasing reliance on IT systems, and you throw in the rising frequency of natural disasters, the risk of operational loss just grows, doesn't it?
Absolutely. They state they maintain a comprehensive global information security program, their GIS program. They use third-party assessors to check it. And crucially, they emphasize robust governance structures, including board oversight and prompt reporting of significant cyber incidents, even those affecting their third-party vendors.
Okay, now here's a risk factor that maybe a decade ago wasn't getting this level of attention: climate change. The filing explicitly states that climate change presents short, medium, and long-term risks. They break it down into physical risks, more floods, wildfires, hurricanes.
Right, damage to actual assets or collateral.
Exactly. And transition risks. What exactly are transition risks in a financial context?
So transition risks are the potential financial impacts from changes in policy, technology, or even market behavior as the whole economy shifts towards a low-carbon future. Think about regulations changing, new clean technologies disrupting old ones, or shifts in investor sentiment.
Okay, so how does a bank even quantify that? Mitigate risks like, say, damage to collateral from a hurricane versus market volatility caused by a rapid shift away from fossil fuels?
That's the multi-trillion-dollar question, really. It's a complex, rapidly evolving area for all financial institutions. They're developing models, but it's definitely challenging.
Yeah, I bet. Okay, and finally, under risk, let's touch on regulatory oversight and systemic stability. We all know deposits at U.S. banks are FDIC insured up to $250,000 per depositor. But the filing mentions the Deposit Insurance Fund, the DIF, is actually below its target level right now.
Yes, that's a significant detail. The DIF is below both its statutory minimum ratio of 1.35% and its long-term goal of 2%. And partly because of that, to recover losses from the Silicon Valley Bank and Signature Bank failures back in 2023, the FDIC imposed a special assessment on large banks.
Ah, okay.
For Bank of America, this meant accruing $1.7 billion for its share of this assessment as of the end of 2024.
Wow, $1.7 billion. That's a direct cost to them from those other bank failures, basically shoring up the system.
Correct. It highlights the interconnectedness.
And this is where it gets really interesting for me. As a global systemically important bank, a GSIB, Bank of America, is subject to the FDIC's single point of entry resolution strategy. What does that actually mean for, say, the average person or even for investors?
Well, in essence, if a huge bank like BofA were to face severe distress, the point of failure, the FDIC has a plan. Instead of chaotic collapse, the single point of entry strategy would involve the FDIC stepping in at the top level, the holding company. They could replace that distressed holding company with a temporary bridge holding company.
A bridge company. Okay.
The goal is to allow the operating subsidiaries, the parts that handle your deposits, loans, keep the ATMs running to continue functioning smoothly. It aims for an orderly resolution, keeps critical services going, and tries to limit the panic spreading through the financial system.
So it protects the system, but what about the original shareholders?
Well, the original equity holders of the holding company would likely take a significant hit, potentially wiped out. The idea is that the losses are imposed at the top, while the core banking functions are preserved. It's a fascinating, though complex, safety net designed to prevent that domino effect we saw in 2008.
Yeah, it really underscores just how critical these institutions are deemed to be for global stability. Okay, shifting gears. Let's look at the financial pulse itself, their key figures and capital. What's the big picture on their recent performance? How did 2024 look compared to 2023?
Overall, the financial picture looks like healthy growth. Their total revenue, net of interest expense, actually broke the $100 billion mark in 2024. It was $101.9 billion, up from $98.6 billion the year before.
Over $100 billion in revenue. Wow.
Yeah. Net income also saw a solid increase, up to $27.1 billion from $26.5 billion. These aren't just big numbers. They signal pretty strong operational performance in what's still a dynamic market.
And their assets, did they grow too?
They did. Total assets grew to $3.26 trillion in 2024, up from $3.18 trillion. And total deposits also increased, hitting $1.97 trillion.
So more money coming in and more staying in the bank. What about their stock?
The filing mentions the aggregate market value of their common stock, held by non-affiliates, was about $309 billion around mid-2024, and they had about 7.6 billion shares outstanding as of February 2025.
Okay. Now, beyond the traditional interest income from loans, where else are they generating significant revenue, that non-interest income line?
Right, that non-interest income, essentially fee-based revenue, saw a pretty substantial increase, up by $4.2 billion to $45.8 billion in 2024.
What drove that jump?
A few key things. Card income was up a bit. Service charges, mainly from Treasury services for businesses, were up. But the really big drivers were investment and brokerage services. That was up $2.2 billion, thanks to higher asset management fees and brokerage fees.
Okay.
And investment banking fees saw a strong rebound, up $1.5 billion from higher debt and equity issuance activity, plus more advisory fees. So it's a healthy mix of recurring fees and a recovery in capital markets activity.
Got it. Looking at their balance sheet then, how are they deploying all this capital? Any significant shifts in what assets they're holding?
Yes, there were some noticeable shifts in 2024. Their trading account assets increased by about $37 billion, and their holdings of debt securities went up by nearly $46 billion.
So buying more securities and holding more trading assets, why?
The filing indicates this was primarily a strategic move to invest the excess cash they had from those higher deposit levels we mentioned.
Putting the deposits to work.
Exactly, rather than letting it sit as idle cash. And consequently, their cash and cash equivalents actually decreased by about $43 billion, showing that active deployment of funds.
Right. Okay, this brings us to capital strength and those regulatory demands we touched on earlier. As a GSIB, they're under strict rules, Basel III, extra capital buffers. How does this impact their day-to-day?
Well, these buffers are crucial. They ensure the bank has enough capital to absorb potential unexpected losses without failing. For example, their GSIB surcharge, that's an extra layer of capital specifically required for these globally important banks, it actually increased by 0.5% to 3.0% in 2024. And it's expected to rise further, maybe to 3.5% by 2027.
Okay.
And their stress capital buffer, the SCB, which is determined by the Fed's stress tests, that also increased by 70 basis points to 3.2% in 2024.
So these requirements keep ratcheting up, and these aren't trivial adjustments, right? They directly impact the bank's flexibility.
Absolutely. Their ability to, say, pay dividends or buy back their own stock is directly tied to maintaining these required capital levels. They need a cushion above those minimums.
Which makes it interesting that the board authorized a pretty big $25 billion common stock repurchase program in July 2024. They actually bought back about $3.5 billion worth of shares in the last quarter of 2024. What does a move like that signal?
Typically, a substantial share repurchase program signals a few things. Management likely feels confident about the bank's future earnings and thinks its stock might be undervalued. It's also a way to return capital to shareholders when the bank feels it has sufficient capital well above those regulatory minimums.
Makes sense. And finally, on the financial side, just briefly, credit ratings. How important are those?
Hugely important. Their credit ratings directly impact their borrowing costs, how much they pay to raise funds in the market. They're also crucial for being able to compete in certain markets, like derivatives trading. And these ratings aren't static. They're under constant review, considering not just the financials, but also non-financial factors, the broader economy, even geopolitical risks.
Okay, a lot hinges on those ratings. Let's move now to understanding credit, specifically the loans they make and the potential for losses. Bank of America maintains an allowance for credit losses, or ACL. That's basically the rainy day fund for loans that might go bad, right?
Exactly. It's their estimate of expected future credit losses embedded in their current loan portfolio.
And the filing says the overall ACL actually decreased slightly in 2024, down about $215 million to $14.3 billion.
That's right. Interestingly, though, when you break it down, credit card loans accounted for the lion's share of that allowance, over 56%, about $7.5 billion.
Wow, over half the allowances for credit cards. How do they manage that risk in their consumer portfolio?
Well, they use a lot of sophisticated statistical techniques. Models built from both external data, like credit bureaus, and their own internal customer data. They use this for everything: underwriting new loans, setting interest rates, deciding on credit limits, and even guiding their collection practices across different loan types like auto loans, securities-based lending, and mortgages.
So lots of data science involved. It makes you wonder how many quants they have just working on predicting credit card defaults.
It definitely highlights how data-driven modern banking has become.
And looking at the actual outcomes for consumer loans, residential mortgage net charge-offs were basically zero in 2024. That seems pretty remarkable given the size of their mortgage book.
It is quite remarkable, suggests continued strength in the housing market, at least among their borrowers.
However, credit card net charge-offs, the loans they actually wrote off as uncollectible, saw a noticeable increase, up to $4.365 billion in 2024 from about $3.1 billion in 2023. What do those two diverging trends tell us?
It paints a bit of a mixed picture for the consumer, doesn't it? While homeowners seem to be doing okay, the rise in credit card charge-offs suggests that some consumers are definitely feeling more financial strain, perhaps due to inflation or higher interest rates impacting their budgets. It's a key area the bank has to monitor closely.
Yeah. And what about the commercial side? Loans to businesses.
For commercial loans, they assign internal risk ratings based on a company's financial position and outlook. These ratings are monitored continuously, and there are obviously approval standards. They specifically mention they're closely watching emerging trends in commercial real estate, particularly the office sector.
The empty office buildings issue.
Exactly. Due to stagnant demand and all the uncertainty from hybrid work models. This is a clear example of how broader economic shifts directly impact their commercial loan portfolio and risk assessment.
So what happens when borrowers, consumer or commercial, start getting into financial difficulty? Do they just write them off?
Not necessarily. The bank often works with borrowers through loan modifications. For consumer real estate mortgages and home equity modifications might involve temporary forbearance, like pausing payments, or sometimes permanent changes to the loan terms.
Okay.
And for credit cards and other consumer loans, they have programs like fixed payment plans, often with significantly reduced interest rates. The filing gives an example of an average rate reduction of nearly 19% in 2024.
That's a big cut.
It is, and in some cases, they might even offer principal forgiveness, though that's less common. They forgave about $113 million in principal in 2024 across these programs.
So these modifications are proactive steps to manage potential defaults, help customers get back on track, and ultimately stabilize their own loan book, too.
Exactly. It's loss mitigation. And one final point on credit-related items. They mention unresolved repurchase claims. These relate to potential obligations from loans they sold in the past, maybe related to representations and warranties made at the time.
Like issues from the mortgage crisis era.
Potentially some legacy issues, yes. The good news is the notional amount of these claims decreased significantly in 2024, down from $5.4 billion to $2.1 billion. Suggests they're working through and resolving these older contingent liabilities.
Okay, good to see that number going down. Let's dive into just a few other critical areas mentioned in the filing. First, legal and regulatory actions. Any major ongoing issues?
Well, there are always some things with a bank this size. In December 2024, the OCC, that's one of their main regulators, issued a consent order. It related to certain aspects of Bank of America's compliance programs for the Bank Secrecy Act, BSA, anti-money laundering, AML, and economic sanctions.
So regulators found some areas needing improvement there.
Essentially, yes. A consent order means the bank formally agrees to take specific actions to remediate the identified issues. Beyond that, they're also involved in litigation regarding how they process electronic payments through the Zelle network. There are allegations about failing to properly investigate and prevent fraud on the platform.
Ah, the Zelle fraud issue. Yeah, that's been in the news.
Right. And there's also an ongoing lawsuit from the FDIC alleging that Bank of America underpaid its deposit insurance assessments by about $1.1 billion for the period 2012-2014. BofA disputes this claim.
Okay, so these legal and regulatory challenges just highlight the constant scrutiny and complex environment these big banks operate in.
Absolutely, it's part of the territory.
The filing also mentions complex financial structures like securitization and variable interest entities, or VIEs. Can you briefly explain how they use these?
Sure. The filing states they use VIEs in the ordinary course of business, primarily for funding purposes and to transfer economic risk associated with certain assets. A common use is securitizing loans, packaging up things like residential mortgages, credit card receivables, or auto loans, and then selling securities backed by those loan payments to investors.
So it helps them manage their balance sheet and maybe raise capital.
Exactly. It allows them to move some assets off their balance sheet, which frees up capital and manages risk exposure. The filing notes that as of the end of 2024, their maximum potential loss exposure related to these VIEs, both consolidated and unconsolidated, was about $2.5 billion.
Okay. And finally, one really interesting area highlighted is their strategic investments in specific sectors. They have huge equity investments in affordable housing and renewable energy projects.
Yes, really substantial amounts. As of December 31st, 2024, they held $16.7 billion in affordable housing investments and $13.0 billion energy projects.
Wow, that's close to $30 billion combined. What's driving these big investments? Is it just ESG goals?
Well, it certainly aligns with ESG principles, but it's also deeply strategic from a financial perspective. These investments generate significant tax credits and other tax benefits for the bank. The filing mentions they generated $2.2 billion in tax credits from affordable housing and $3.9 billion from renewable energy in 2024 alone.
Billions in tax credits.
Yeah, largely driven by their investments in wind and solar energy facilities. So you could argue this makes Bank of America a really powerful, if somewhat quiet, financial engine driving investment in America's transition to lower carbon energy and addressing critical housing needs. It's a multifaceted strategy delivering financial returns alongside societal benefits.
That's fascinating. It's not just philanthropy. It's baked into the business model. Okay, well, we've navigated the pretty complex landscape of a major financial institution today. We've gained insights into its core operations, its approach to its workforce, the myriad risks it manages, its financial performance, and how it handles credit and regulatory challenges. Hopefully you now have a clearer picture of how a behemoth like Bank of America actually functions day to day, from those specific business segments right through to its global risk strategies.
Yeah, this deep dive has hopefully provided not just, a list of facts, but more of a framework for understanding all the layers of complexity. This is a company whose daily operations really do touch millions of lives and have a huge impact on the broader economy. It's about seeing those threads that connect what might seem like disparate pieces of information into, hopefully, a more cohesive whole.
So wrapping up, what does this all mean for you, the listener? When you see a single institution dedicating millions of hours to employee training, managing literally trillions in assets, and setting aside billions for unforeseen events like natural disasters or even other bank failures, it really begs the question, doesn't it? How much of our global economic stability relies on the meticulous, often unseen, risk management and operational diligence of these financial giants? And maybe more importantly, what does that reliance mean for the future as new technologies like AI and new global challenges like climate change emerge at an ever-increasing pace?
That's the big question going forward.
Definitely something to think about.